Welcome back. Today I continue with integrating NIPA, stocks, flows, and the flow of funds account. Now that the flow of funds is, I believe, what Mike Norman was talking about, the flow of government spending, that sort of thing. Anyway, so let's see, 6.4. The sectorial balances framework, which is derived from the national account framework, was explored in section 6.2. It is intrinsically linked to the flow of funds analysis. They are different excuse me, related ways of related ways of considering a national account activity. An early exponent of the flow of funds approach, Lawrence Ritter, wrote that the flow of funds is a system of social accounting in which a. The economy is divided into numbers of sectors, and B. Sources and users of funds statement is constructed for each sector when all these sector sources and uses of funds statements are placed side by side. We obtain C. The flow of funds matrix for the economy as a whole. Thus, the flow of funds accounts allow us to link a sector's balance sheet statements about stocks of financial and real net wealth to income statements about flows, in a consistent fashion. In a monetary economy, flows and expenditures measure in terms of the money of account spent over a period involve transactions between sectors in the economy which also have logical stock counterparts, that is, flows feed stocks. The flow of funds accounts ensure that all of these transactions are correctly accounted for. This thinking underpinned the work of the so-called New Cambridge approach that was part of the Cambridge Economic Policy Group at the University of Cambridge in the early 1970s. Key members of this group were Martin Featherstone, Wynne Godley, and Francis Cripps, all of whom were of Keynesian persuasion. Some make it like a species. Anyway, um, while the sector balances approach had been understood much earlier, for example, by Nicholas Caldor and others, it was popularized by the New Cambridge macroeconomic analysis, which put the concept of the net acquisition of financial assets, or NAPA, into the forefront of its Keynesian income expansion model. Like Lawrence Ritter, the Cambridge economists were interested in tracing the flow of funds between the different sectors of the economy, which they divided into a government sector, the private domestic sector, and the external sector. These transactions are recorded for a given period, and each sector could record a financial deficit or surplus. We rewrite equation 6.6 as follows. 6.7. S is S to I equals NAPA equals G to T plus CAB. S to I is the private domestic financial balance of NAFA of the private domestic sector. The private domestic sector is in financial surplus or deficit when its disposable income GNP to T exceeds it is less than its spending on consumption goods and investment goods. From a stock perspective, NAFA can also be measured by the difference between the private domestic sector's stock of net financial assets at time t into I and on the stock at time t. So if t is 2017, t is to I would be 2016. If G is to T is under 0, then the government sector is spending less than it is taking out of the economy in taxation and undermining the capacity of the other two sectors to accumulate net financial assets by running surpluses and vice versa. CAB is the external sector financial balance, the current account balance, and comprises the trade balance, that is, the difference between export and import revenue on goods and services, and the net income flows that accrue to residents as a consequence of interest and dividends received on overseas ownership, offset by similar payments to foreigners. If the overall external sector balance is in deficit, then the national economy is issuing liabilities abroad or running down its net financial position in other ways, and foreigners are accumulating financial asset claims and vice versa when the external balance is in surplus. Noting the stock/flow distinction, equation 6.7 can be interpreted as meaning that if its right-hand side is positive, then G is to T plus CAB is greater than 0, and the government sector fiscal balance plus the current account balance jointly generate national income and additional net financial assets for the private domestic sector. Then NAPA is greater than 0, which means that the private domestic sector is running a surplus and acquiring new assets and or reducing its existing debt obligation. Think of this as what happened with the STEMI. That was everybody's new assets, and they reduced their existing debt obligations by paying off credit cards and rent and mortgages and whatnot. Conversely, if the government sector fiscal balance plus the current account balance is negative, this would reduce national income and undermine the capacity of the private domestic sector to net save and add to its stock of net financial assets. Again, I said I get lost sometimes. In this case, NAFA is less than 0, so that the private domestic sector is running down its net financial position by borrowing from the other sectors and or by liquidating some of the stock of the accumulated wealth. Equation 6.7 can also be run as 6.8. S goes to I, then goes to CAB, then goes to G to T, where the term on the left-hand side, S to I, goes into CAB is the non-government sector financing or financial balance and is of equal and opposite sign to the government's financial balance, G to 7. This is the familiar MMT conclusion that a government sector deficit surplus is equal $1 for $1 to the non-government sector surplus deficit. Importantly, transactions within the private domestic sector do not alter the net financial position of the sectors overall. So if a bank creates a loan for one of its customers, then its assets rise, but on the other side, liabilities of the consumer increase by an equal amount, leaving no change in the net position of the sector. That's if interest rates are at 0, pretty much. The only way the private domestic sector can increase its net financial assets overall is through transactions with the government or external sector. For example, by acquiring a government bond or buying a foreign government bond or a foreign corporate bond. These 2 points are key MMT insights. Once we understand the interlinked nature of the 3 sectors, then it is a simple step to realize that if one sector has improved its position by the net acquisition of financial assets following a financial surplus, at least one of the sector must have reduced its net financial assets or run a financial deficit. The flow of funds framework allows us to understand that the funds which a particular sector receives during a period from current receipts, borrowing, selling financial assets, and running down cash balances have to be equal to the total of its current expenditures, capital expenditures, debt repayments, lending, and accumulation of the cash balances. This approach clearly allows us to trace the uses and sources of funds for each sector. It should be emphasized that the flow of funds approach is based on accounting principles rather than being a behavioral or theoretical framework for understanding why these flows occur. Nor do we gain any insight as to the adjustment process that govern the change in net financial assets in each sector. That caveat is not to be taken as a criticism of the approach but merely an observation of its restrictions. It also doesn't reduce the utility and insights that the approach provides. Often the economists like to denigrate analysis that manipulate accounting identity as being too low-brow, but any approach is valuable if it provides useful ways of thinking. Causal relationships. From the discussion above, it is clear that a non-government surplus is the same thing as a savings flow, which leads to the net accumulation of financial assets. By the same token, a deficit reduces net financial wealth. If the private, domestic, or external sector runs a deficit, it must either use financial assets that it has accumulated to previous year when surpluses were in run, or it must issue new IOUs to offset its deficit, that is, borrow. Thus, this sector pays for its deficit spending by selling assets and reducing its bank deposits or saving, or it borrows and issues debt to obtain bank deposits. Once it runs out of accumulated asset, it has no choice but to increase its indebtedness every year that it runs a deficit. On the other hand, if the external or private domestic sector runs a surplus, they will be accumulating net financial assets. This will take the form of the financial claims on at least one of the other sectors. As we will discuss later, it is misleading to apply terminology such as dissaving or borrowing to the sovereign government which issues the currency. While we have identified an accounting relationship between the sectoral balances, we can also say something about the causal relationship between the flows of income and expenditure and the impact on stocks. Individual spending is mostly determined by income. For individual, it is plausible to argue that income determines spending because an individual with no income is certainly going to be severely constrained when deciding to purchase goods and services. However, on reflection, it is apparent that even at the individual level, the link between income and spending is loose. One can spend less than one's income accumulating net financial assets, or one can spend more than one's income by issuing financial liabilities and thereby becoming indebted. Still, at the level of the individual household or firm, the direction of causation runs from income to spending, even if the correspondence between the two flows are not perfect. Next time, I'll be reading Deficits Create Financial Wealth. Well, that is just fun. We can also say something about the direction of causation regarding the accumulation of financial wealth at the level of the individual. If a household or firm decides to spend more than its income by running a deficit, it can issue liabilities to finance the additional purchases. Another household or firm will accumulate these liabilities as net financial wealth. Alternatively, they might allow the government to run a fiscal surplus. Of course, for this net financial wealth accumulation to take place, we must have one household or firm willing to deficit spend, and another household firm as government willing to accumulate wealth in the form of liabilities of that deficit spender. It takes two to tango. However, the decision to deficit spend is the initiating cause of the creation of net financial wealth. No matter how much others might want to accumulate financial wealth, they will not be able to do so unless someone else is willing to deficit spend. Still, it is true that the household or firm will not be able to deficit spend unless it can sell some of its accumulated assets or find someone willing to hold its liabilities, such as a bank, through the creation of a loan. In the case of sovereign government, there is a special power, the ability to tax, that guarantees that households and firms will want to accumulate the government's debt. We conclude that while causation is complex, it tends to run from an individual deficit spending to accumulation of the financial wealth, and from debt to financial wealth. Since the accumulation of a stock of financial wealth results from a surplus, excuse me, that is, from a flow of saving, we can also conclude that causation tends to run from deficit spending to saving. At the sectoral rather than individual level, the same principle applies. Thus, one sector cannot run deficit if no other sectors will run a surplus. Equivocally, we can say that one sector cannot issue debt if no other sector is willing to accumulate the debt instruments. At their aggregate level, taking the economy as a whole, causation is clear. A society cannot decide to have more income, but it can decide to spend more. Further, all spending must be received by someone somewhere as income. In other words, aggregate spending creates aggregate income. Finally, as discussed above, spending is not necessarily constrained by income by income, because it is possible for households, firms, or government to spend more than income. Indeed, any of the three main sectors can run a deficit with at least one of the others running a surplus. However, it is not possible for spending as an aggregate level to be different from aggregate income, since the sum of the sectorial balance must be zero. For all of these reasons, we must reverse causation between spending and income when we turn to aggregate level, while at the individual level, income causes spending. At the aggregate level, spending causes income. In MMT, we differentiate between horizontal and vertical transactions within the economy. Horizontal transactions occur between people and firms within the non-government sector. For example, excuse me. For example, purchases of goods and services, borrowing from banks. Vertical transactions occur between the government sector and the non-government sector. For example, government spending and taxation. Horizontal transactions do not add to the stock of the net financial assets held by the non-government sector. Much of the debt issued within a sector will be held by others on the same sector, in the same sector. For example, if we look at the finances of the private domestic sector, we will find that most business debt is held by domestic firms and households. In the terminology we introduced above, this is inside debt of those firms and households that run budget deficits, which is held as inside wealth by those households and firms that run budget surpluses. Likewise, if households choose to deficit spend, that is, spend more than their flow of annual income, then they may secure bank loans. There we go. In that case, the net asset position of the private sector is unchanged. These are horizontal transactions. The student loans may be privately financed or financed by a government. In both cases, there is a horizontal transaction. If the domestic private sector, taken as a whole, spends more than its income, it must issue outside debt, held as outside wealth, typically held by the foreign sector. However, the stock of net financial assets held by the non-government sector, private, domestic plus foreign, is again unchanged since these are horizontal transactions. The initiating cause of the private sector deficit is assumed to be a desire to spend more than income, so the causation must go from deficits to surpluses and from debts to net financial wealth. While we recognize that no sector can run a deficit unless another wants to run a surplus, this is not usually a problem because there is a propensity to net save financial assets. Vertical transactions add to the stock of net financial assets held by the non-government sector. On the other hand, assume that a fiscal deficit occurs perhaps as a result of the increase in government spending, and for simplicity, the CAB is zero, then the private sector achieves a net increase in its stock of financial assets. This transaction between the government and private sector is referred to as a vertical transaction, and in this instance leads to an increase in net financial assets held by the non-government sector. On the other hand, if the government runs a fiscal surplus by taking net spending out of the economy, with the CAB again being zero, the non-government sector, specifically the private sector, suffers a loss in its net holdings of a financial asset. In this section, we demonstrate how a flow of funds approach to the analysis of a monetary transactions highlight both the importance of the distinction between vertical and horizontal transactions and the fundamental accounting nature of the so-called government budget constraint, or GBC identity, which we will refer to as the government fiscal constraint. What you just heard, in the last portion anyway, was basically what happened in the 1990s when Bill Clinton decided to cut spending and taxed more. When you do that, almost nobody keeps their surplus of cash as far as non-government. So Bill Clinton pretty much screwed this country in more ways than one. The other way was deregulating the fire sector, allowing them to play around, F around, and found out that if one person loans out to those who are unable to financially afford it but push it, then they're guaranteeing a financial crisis. So this is pretty much what, say, for instance, Austrian economists say is good for the economy, a free market, quote unquote, deregulated. This is what happens. Those who had the propensity to take out loans they can't afford due to the fact that their wages are not up to snuff as far as paying back that loan with that interest. Then you also have those who are pushing for more sales, more loans of real estate and stuff of that nature, get paid higher in order to push that. That creates more incentive to do more damage. So, either way, if you look at it, Austrian economics is not the way to go in a fiat currency with a floating exchange rate that's no longer pegged to a gold, which then is pegged to a financial constraint. Anyway, but that's it for now. Next time would be the balance sheet. 6.5. I think we got that. Yeah, 6.5.